Are we in trouble? Yes. Should we all be concerned? Absolutely. But is it time to panic? No. At least not yet. It's actually never a good time to panic, but the labor market is in trouble and needs help from the Federal Reserve. Because if they don't intervene, it'll be a much bigger issue later on down the road. But here are the facts. The BLS has just revised the number of jobs that were added last year, and it came back that they added 911,000 jobs less than what was reported. Yes, you heard that right. They added nearly 1 million jobs less than what was reported last year, making it the largest revision in history. So this means that the labor market has been in trouble for a lot longer than we all thought. And that's concerning. Treasury Secretary Scott Bessent came out to talk about it this morning, and he has an interesting take on this whole thing. I'll play the video, take a listen.
If the Fed says they're data dependent and the data has been atrocious, then it seems like there's probably some makeup cuts in order here, or the size of this month's cut needs to be recalibrated. And sure, it could be fixed. Anything can be fixed. You just have to first, we had to establish that it was broken, which President Trump did. Now we have to go about fixing it. And it wasn't working well before, that kind of this lazy notion that they had dropped down to these low response rates, 30, 40% response rates, and they intuited the balance. Intuiting the balance is going from quantitative to qualitative. We need good empirical data, and it's not easy to get to, but you got to want to get there, and we want to get there.
So he said that the data shows that the Fed should have been cutting interest rates for a few months now, and he's suggesting that a makeup rate cut is necessary to make up for lost time. Who knows what they'll ultimately decide to do, but I'll talk about it in great detail later, so stick around. Aside from this major revision, another big concern in the labor market is the weakening job growth. Recent data shows that jobs have significantly slowed down their hiring in the last few months. August job report showed that only 22,000 jobs were added for the month of August, which is well below expectations of 75,000. So it missed expectations by 70%, and only 85,000 jobs were added in May, June, and July combined. So jobs have been really slowing down their hiring process all year. When it comes to the unemployment rate, I don't think it's that big of a concern as of right now, but it's definitely something to keep an eye on, because the unemployment rate is currently at 4.3%, which happens to be the highest level since 2021, but it's still a fairly low number, especially if you compare it to this chart. So just keep an eye on it, and I'll continue to keep you posted. By the way, if you're getting any value from this video, please give it a thumbs up. Thank you. So job growth is slowing, job cuts are increasing, and there's a lot less people who are employed than what's being reported. And what does this all mean, and why am I concerned? Well, if job openings continue to decline, it can spark an actual major recession. Now, I'm not one of those people who fearmonger and puts fear in everyone for no reason, because positivity is king and there's enough negativity going around. However, a recession is the long-term risk of all of this going on. Less jobs hiring means higher unemployment rate, which then leads to less spending towards the economy, which will then lead to a declining GDP. So hopefully the Fed decides to intervene to prevent all of this from happening. Speaking of which, the Federal Reserve is set to cut interest rates next week to help put this fire out, but hopefully it's not too late. According to the CME Fed tool, there's a 93% chance that they'll cut rates by 25 basis points next week, and a 7% chance that they'll cut interest rates by 50 basis points. If you look at the odds for the Fed meeting in October, the Fed has a 73% chance of cutting interest rates by another 25 basis points, and a 21% chance of them leaving rates alone. There's still a lot more data to come by October, so these numbers will be very different from where it's at right now. But it would not surprise me if we continue to see the labor market continue this sharp decline. If they cut interest rates big enough, it'll save the labor market from this mess that's been going on, and it'll actually also stimulate the economy even more. Lower interest rates makes it cheaper to borrow money, which leads to more people spending money on goods and services, which will then make businesses having to expand and hire more people to meet the demand. And the stock market, of course, will continue to increase. I'll continue to invest as everything plays out, because if the Fed saves the labor market by cutting interest rates, then people with most assets will be the major winners. And the separation from the middle class to the upper class will continue to increase. So stay invested, continue to dollar cost average, and continue to pay attention to what's going on.